Hi, welcome to our new Level Up series entitled Personal Residence. This episode is all about knowing mortgage interest credit, our plans, and where we're headed. Just a quick overview of Mortgage Credit Certificate or MCC. The Mortgage Credit Certificate MCC program was created under the Tax Reform Act of 1984 as a way to promote home ownership among low and moderate income families. It reflects a broader government paradigm using tax incentives to encourage socially beneficial behaviors such as purchasing a home, which is considered a cornerstone of economic stability and community building. Now let's talk about the following key questions: who, what, why, when, and where. Who generally targeted at first-time home buyers, those who haven't owned a home in the last 3 years, must meet income limits and purchase price limits which vary by state or locality, and the home must be buyer's primary residence. What? The first key step in pursuing a mortgage credit certificate or MCC is to consult with a local lender that participates in the MCC program. This ensures that you understand the qualifications, application process, and how the MCC will work with your mortgage. The case usually is your state or local housing finance agency or HFA has a list of approved lenders who can process MCCs. Not all lenders offer MCCs, so starting with a lender experience in the program is crucial. Why? It saves more in taxes by taking credit instead of deduction. It has a direct impact on your tax liability rather than reducing your taxable income. MCC allows qualified home buyers to claim a tax credit under federal income tax return equal to 10 to 50% of the interest paid. When? Here's an actual timeline. First, you check if you meet the income and first time requirement and check if your desired location qualifies for MCC. And then you apply for MCC with a lender or county or state, and you actually get the MCC in hand, and then you report the tax credit on annual tax return filing. The MCC is tied to your mortgage, so you need to qualify for a mortgage first. The lender will help determine if you can meet the financing requirements. Once you pre-qualify for a mortgage, the lender will guide you through the MCC application. This often involves in coordination with the HFA. Again, you must get the MCC first before getting the mortgage and purchasing home. Usually, there's a pre-qualification for the mortgage, and then if the MCC is secured, you'll get the mortgage and you'll get your home, and you annually file your tax return and also your MCC every year of ownership. Next is where you report it every year under Form 8396 or your mortgage interest credit. To have a working knowledge on how mortgage interest credit works, let's have different examples. Again, MCC usually ranges from 10 to 50%, and MCC is a non-refundable credit. The 20% threshold happens to be here, and if the MCC is 20% or less, you get the actual percentage applied to your interest paid, and if you have your 21% or more, you can only have a 2,000 maximum credit. Let's have our first example. Let's say a client get an MCC rate of 15% and she paid $20,000 based on her Form 1098. Her rate is still within the 20% threshold. That's why we can apply the 20,000 multiplied by 15%. She'll get a tax credit amount under Form 8396 of 3,000, and the remainder of 17,000 will be reported under Schedule A as her mortgage interest deduction. Next example, let's say client B got a 10% MCC rate, still within the 20% threshold. His mortgage interest paid based on his Form 1098 is 25,000. The credit amount is 25,000 times 10%, that's 2,500, and the remainder of 22,500 will be reported under Schedule A. Next, client C got a 25% MCC rate, that's beyond the 20% threshold. Therefore, her only maximum credit is limited to 2,000, not the 20,000 times 25%, but only 2,000. But the remainder of 80,000 will still be reported under mortgage interest deduction under Schedule A. Now let's have an example talking about MCC as non-refundable credit. Let's say client A here got a credit amount of 3,000, and based on her 1040, her tax liability is at 5,000. She can fully utilize the 3,000 tax credit, and her tax due will now be reduced to 2,000. Another example is that client B got a credit amount of 2,500. His tax liability based on his 1040 is only 1,000. His tax credit utilized will still be at 1,000 because the tax due will have to be zero. You cannot claim the whole 2,500 credit amount because MCC is a non-refundable credit. What happens here is that the 2,500 less the 1,000 tax credit limited to his tax liability, the remainder of 1,500 will be carried over for the next 3 years. Again, MCC is a non-refundable credit. That's why his tax due is zero and not a refund. Our key points to fully maximize the government's MCC program: once you get the best lender or bank securing your MCC, got a good mortgage, and having the best personal residence as of the moment, you can manage your cash flow, check the efficiency of your tax credit timing, check with your tax professional if your personal decisions are still maximized with the best tax strategies. Keep records, keep Form 1098 and other statements from your lender, and ideally, let's say you're currently here. You can discuss your options. In the long run, your income level may increase or you purchase a new home, and discuss with a tax professional to properly plan ahead not only your taxes but also your life to get the most out of it. And that's it for our first episode for this series, Personal Residence, No Mortgage Interest Credit, your plans and where you're headed. See you on the next one.